Please bear with me here because I'm using two computers to start on the broadcasting. So we might not have a direct eyes contact. I might get distracted sometimes. Okay, hello everyone. Welcome to today's topic, and it's about the introduction to short selling. And I'm very excited to have you here as we will dive into one of the most important aspect of the options trading, which is how to generate passive income through short selling. Actually, this is very funny topic. It is a very interesting topic since we can replace the usual buy and sell in the stock market with the short selling options. And let me state it clear. This session is totally free, and we are not getting you any information. We are not selling you courses. We are not going to collect your personal information such as your email address and your phone number. So please enjoy these sessions together with me and hope that we can learn something very important and maybe a life-changing knowledge. And let's start on how we can use short selling in options to generate passive income by replacing the usual buy and sell in the stock. We will be discussing on the strategy you can use to replace the traditional stock order and the factors that will affect your income, and also the reasons why short selling can be so profitable. By the end of the sessions, you will have a clear understanding on how to apply this strategy to your own tradings. And our agenda today will cover three key areas, which is the first one, the beauty of short selling in options and how it can generate a passive income. And the second is the key factors that will affect the premium that you can earn, including the volatility, the time value, and also the winning rate. And of course, I will demonstrate all these concepts in a live trading interface using the Usmart, so you can see exactly how to apply them in a real life situations. Let's get started, okay? So to kick things off, let's talk about how this concept of short selling options and why it's such a powerful tool for you to generate a passive income. So let me remind you again, what is short selling? Wait a second, yeah. It seems like the screen is breaking up. Okay, so a short put is actually an alternative to buy limit order. So according to the last class, we will see that if a price drop to a strike price, the seller will have the obligation to buy. In this case, you might find that it is very familiar, as it is because this is actually the same concept as a buy limit order. When you want to purchase a stock at a lower price, so you place a buy limit order. But in this case, you can replace it with a short put instead. But here's the thing, instead of placing a limit order and wait for the price to drop, you can actually sell a put options. So if the price drop to the strike price, you still end up buying the stock, but you will earn a premium in the progress instead of paying the cost. Let's say that when the price is rising up, and you can just place a short put in the level below the current price, and then when it comes down to hit your order, the level that you set your short put, you will end up buying up the stock, and then it will go up. In this normal scenario, if you're using a buy limit in buying a stock, you will end up paying a cost to buy the stock. But in this case, instead of paying a cost, you will earn the premium instead. And the short call is actually an alternative to a take profit orders. For those you already own the stock, you may place a take profit order to sell when the price hits a certain level. But in this case, you can put a short call instead. When you put a short, what is a short call? A short call is actually the seller will have the obligation to sell when the price rises to a certain price to your strike price. So that in this case, when you already bought the stock, you can just place a short call at the upper level, and then you can just wait for the order wait for the option to get executed. So at the end, you will end up selling the stock on hand, while you can also earn a premium. In this case, if you combine all those two together, you will see that actually you are just doing a very simple buy low, sell high option actions on the stock. But in this case, instead of paying the cost, paying the fees for your trading, you end up earning some premium when you are doing the buy low, sell high actions. So you can just replacing the buy with a short put and replace the sell with a short call. Please wait a second, yeah. I'm setting up the others live platform instead. Okay, so that in this case, you actually earn a premium regardless of the exercise. So no matter whether it's the option get exercised or not, you will end up keeping the premium. But it's just the matter that either your stock order will get filled up, or you get sell out to the market or not. So comparing to the normal buy limits and take profit orders, by using the short selling in options, you can actually just keep the premium on hand, while no matter whether the option get filled or not, you can earn the premium. And if this get exercised, this actually work the same as the buy limits and the take profit order. Now let's see how do we get to able to make a short selling in the options. First, you can just check on the interface in the Usmart trading apps, and when you search for a stock, and then you can see that in this case we are using an NVIDIA as an example, and then you can just see that it's actually on the bar there's a options button on top. Once you click it, it will show into the options trading interface. And then this is how the call options and put option are located. You can see from the green box, is actually the premium that you will get when you are doing a short selling in put, and the break box is actually the premium that you get when you are doing a short selling in call. So in this example, in NVIDIA, I will use NVIDIA as an example. The current price is 143.71. If I want to buy low, let's say that I'm actually targeting a 130 as my entry price. So I will just take a short put at 130, and then I will immediately receive 28.90 per share, which is equal to 2,890. So when the price dropped to 130, I will buy 100 share of NVIDIA, but even though it didn't drop to that level, I will still keep this premium on hand. At the moment that I make a short put, I will receive this 2,890 immediately. And then I will keep this no matter whether the price drop to this level or not. If it doesn't drop to this level, the option will just get expired and I keep this in pocket. If it drop to this level, it's just exactly the same like I'm doing a buy limit order. I bought the share while I earn the premium. So it's very obvious that this is actually work exactly the same as the buy limit order, but with the benefit that you make a premium. Now, this is only when you enter a position, which means that when you are making a short put, and then the price actually dropped to 130, and you get exercise. The option get exercised, and you bought a 100 share of NVIDIA. Please bear in mind that you only do a take profit when you have the stock on hand. In this case, we want to do a buy low, sell high. So that the market price is at 143, we want to buy low at 130, and we sell high at 188. So I make a short call at 155, then I will receive the premium immediately. In this case, which is 43.82 per share. And then one options will equal to 100 share. So that it will make it a 4,382. So what happened in the future if the price get rise to that level? If the price get to rise to that level, I will able to sell the stock on hand at the desired price, which means when it dropped to 130, my short put get exercised. I bought in 100 share of NVIDIA, and now this 100 share of NVIDIA able to sell at 155. And then some more, I did make a very good return on the premium itself from the 2,000 previously and also the 4,000 now. If it stays below 155, I will still keep this 4,352 premium without exiting my position, just like normal take profit order when I buy the stock and then I put a take profit. But the price didn't get to reach to that level. So I will still keep the stock on hand instead. So in this case, if I'm able to bought in the price with a short put in a short put, and also able to exit with a short call, this is the premium that I will get from just placing the order. The premium that I will get from the short put is 2,890, while the premium that I get from the short call is 4,352. This is where you can check it. Actually, you need to just multiply this number with 100 instead, because one option is equal to 100 share. And some more, you're actually doing a buy low, sell high actions. So this is how you get the profit from the principal growth. in this case, you have 100 share of NVIDIA if both of them get exercised. So actually, one share you are making 25, which is 155 minus 130. So in this case, in the normal situation, when you do a buy low, sell high, you actually just earn a 2,500. But in this case, you are actually making a lot more than the 2,500, which is a total of 9,742 instead. You can see that this actually multiply your return by many percentage, instead of just doing a normal buy low, sell high in the stock option in the stock market. You are actually making a profit from the premium and also making a profit from the principal growth. Now let's dive into what will affect the amount of premium you can earn. In the last example, you can see that the premium from the call and also from the put are different. One is 20 something, one is 40 something. And you need to learn that what will be the factor that affecting the premium. In this case, which will affect your passive income. One of the most important factor is volatility. The more volatile a stock is, the higher the premium. Because when the volatility gets higher, the chance of the option to get exercised will be greater. Let's think about this way. If you are buying an insurance policy, and the cost of the policy will depend on how risky you are. If your health check show a higher risk of illness, the policy will be more expensive. It's same with the option, because in the last courses, we just learned about options is actually insurance in the financial market. So in this case, let's imagine that you are a buyer from the insurance policy, and you have a higher risk of illness. So of course, the premium will get higher. So if a stock is more volatile, the premium that you collect is higher, because there's a higher chance of the price get moved significantly. To better understanding this, there's actually a way to check on the volatility from the market and also from the stock itself and also from the options. There are 3 volatility index you can check whether you can know that is it a good time to buy an option or sell an option. So let's move on to the market volatility first, which is the VIX index. To better understanding the market volatility, because we want to just look at it as a whole first, because before we get into the detail part, to better understanding the market volatility, we can just look at the VIX index. VIX is actually, it often called the fear index. It measures the market expectations for future volatilities. When the volatility is low, the market is calm, and the option premium are generally lower. When the VIX is high, the volatility is expected, so that the premium will increase. Just remember this. When the volatility is high, the premium is higher too. It's a linear correlationship. So you can just check the VIX on most of the trading platform. And this is my definitions on the VIX number. If the VIX is staying between 10 to 20, it says that the current stock market is actually at the normal situations. But if the VIX get higher than 30, which means that the current market is very unstable and actually very volatile. And this is where you can check the VIX index. As you can see, most of the time it stays in between 10 to 20. And then when there is some time that it across the 20 index, it means that there's a very high volatility in the market, and that is the time I would suggest you to do a short selling instead, because the premium that you will get will eventually higher than the normal market. If you are going to be a buyer instead of the seller, you can just wait for the VIX number to stay below 15 instead. The next one will be implied volatility. Now you already know how to check the market volatility, and we will go into the detail. The detail which will be the stock volatility and also the option volatility. In the option volatility, you can just check on the index, which is implied volatility. This actually a parameters that show on the options itself. It measures the future volatility of the particular stock, the percentage move for the stock to move in 1 year. So for a longer options order, you will want a lower IV because you're paying a premium. For a short options order, a higher implied volatility is better because you are receiving a higher premium. This is how you can define whether the implied volatility is high or low. When the implied volatility stays in between 35 to 50, it shows that it's in a normal market. But when it's greater than 50, it shows that it's in a very high volatility market. So in this case, you can just check on, there's no chart for implied volatility, but you can just check on in the trading platform itself. It will just show like exactly like this. When you go into the options interface, you can just check on where is how much is the current implied volatility. In this case of NVIDIA, you can see that the implied volatility actually fall in between 43 to 57. So I would say that this is actually at the borderline of getting into a very high volatility market. This might be a good sign to sell, but just depends on what is the timing. If both of them are greater than 50, you will get a very great premium from it. And the next one we will check is from the chart itself, the average true range. This is the indicators that you can check on the graph. This is a technical indicator, which it measures the stock volatility over a set period. In this case, by default, it will be 14 days. And I will give you a little small tips on how to identify whether the stock volatility is increasing or not. You can just add a moving average to the ATR technical analysis instead to identify the momentum changes in the price movement. By using a TradingView platform, you can actually see that I do add on a average true range indicator at the bottom, and I also add on a moving average indicator onto it. And you can see when there's a blue area appear, it means that the momentum of the price movement actually way past the historical 14 days movement, which means the market is getting volatile. In short, you can just understand this as when the indicators show a blue area, this is a very good timing for you to get short, to get a short selling order. If you get into the pink area, which means the market is slowing down. This stock itself is slowing down. So you can actually try to get involved in the uptrend or downtrend itself. You can just buy the long options or you buy the put option instead of doing a short selling. Just remember this. Blue area equal to short selling. Pink area equal to long on the options. This is a little small tips from my side. And when you combine all these volatility indicated by together, in order to get a higher premium, you always aim for a higher volatility. When the market is unstable, you can earn a very great amount from the premium itself. So let us summarize what is the indicator that we are going to look on. For the market volatility, you need the VIX to be greater than 20, which means the market now is very volatile. And now you already know that the market is volatile. Which stock are you going to pick? Then you need to check on the stock volatility, the implied volatility. If the IV, which show the possibility of the stock to move in 1 year, is greater than 50, it means that this stock is involving in the high volatility market, and this is one of the top tier stock that you can get into a short selling position. The last one will be the volatility momentum, which is the things that you can check on the TradingView platform. So when these three indicators show on all together, it might be a very good chance for you to get into. Okay, so instead of volatility itself, there's another factor that affecting the premium, which is the time value and the options pricing. The time value will actually affect the options pricing a lot. The longer the time until the options expiration, the higher its value. This is because there will be more uncertainty during that time. The longer the time period, the more uncertainty it is. So just like buying an insurance policy, you will be willing to pay more for the insurance policy that cover for a longer time frame. Let's say that I'm selling you an insurance policy that expired tomorrow. How much are you willing to pay me instead? You might not willing to buy from me because you will know exactly what happened tonight and what happened tomorrow. So there will be unlikely to happen any accidents, so you won't buy from me. But what if I'm going to sell you an insurance policy that cover you for the future 10 years, 20 years? Are you willing to buy from me? If you are willing to buy from me, I'm going to charge you more than what you expected. This is what we mean by the time value will affecting the option premium. The longer the time that you get cover, the higher the price the option will charge. And how do you check on the time value on the options, which is the theta and the time decay? The time value will decrease as the expiration date approach. When the expiration date get closer, the less likely is that the price will move significantly. So as a result, the option will lose a value over time. The closer the expiration date, the higher the theta, and more favorable to the seller. And let's check on the theta. What is the theta? And you can check on, I show you two examples of the option and options theta. For the first one, which is on the options that will expire on November 1, the theta will be allocated around negative 0.222 to negative 0.23. And for another one, which is the options that will expire closer on October 25, the data will be allocated on 0.3. What does it mean by a data? A data is actually the depreciations of the options premium, which means the premium now is selling at 20, for example, and then the next day, how much will it deduct? In this case, it will deduct 0.2 and also 0.3. So you can see that the closer the option expiry date is, the more depreciation you will get. And the further out the option is, the depreciation will get slower and you can get maintained on the certain level. So if you are going to buy a long and buy a put, I would suggest you to actually look for a higher time, a further out expiration date instead of a closer one. Let's say that you are going to target on a certain stock, and then I would suggest you to just check for the option that expired after 1 year, but minimum 1.5 months. If you are buying an option with less than 1.5 months to expiration, you will pay a lower premium because it's going to get expired soon, and the value itself get depreciated quite a lot. And at that time, you will get to pay a lower premium. But if you are selling an option with more than 1.5 months to expiration, you will collect at a higher premium because the greater the uncertainty is, the higher the premium. It depends on whether you want to decide on what expiration date you choose. The further out, the premium will get higher. The closer the expiration date, the premium will get lower. So are you going to aim for a higher return for more uncertainties, or you are going to aim for a smaller return with less uncertainties? This is up to your choice. So understanding the time decays is essential when deciding which option to sell. You can maximize your passive income by selling the option with a longer expiration date, where the premiums are higher due to added uncertainties. And after this, we will just talk about, we already talked about the volatility and the time value. And then I will just introduce you a theory that will increase the winning rate of short selling comparing to a long parties. Why the winning rate of short selling is higher than the long parties is because when we are doing a short selling, we actually act like an insurance company. We are the insurance company that sell the insurance policy. Let's check on all the insurance company around you. How many of them are making money instead? The insurance company actually make money by betting that nothing will happen to the people that insure. They collect the premium from many clients, and only a small percentage of those policies will get to pay out. And the same principle will apply to the selling options. Whenever you are making a short selling in the options, most of them are actually will get expired without getting exercised. This is because the stock price actually follow a theory which is a normal distribution. It's said that the price will stay within a certain range and it won't make very dramatically. And then we will just I'll just show you the chart of normal distribution instead. This is actually a normal distribution chart, and you can imagine the middle line. The middle line is actually where is the current price allocated, and then it showed that the probability that it will move around the current price is actually higher, but the probability that for it to just move with a bigger movement is actually lower. So that in this case, if you are expecting a breakout to a certain level, you are actually targeting on a bit a bigger movement. So you are betting on a smaller winning rate. But if you are not targeting on the breakout instead, you just want the price to stay between certain area. In this case, if I want the price to stay below some level, you can see that it's actually the winning rate is actually higher. Let's say that I'm going to target the price won't move across one standard deviation. So I make a short selling at that level, and then I'm actually have a higher winning rate, which is 34 plus 34 plus 13.5 and the 2.35. This is actually a very difficult calculation method, but most of the apps will actually show on how to the actual winning rate by itself. You can just explore the apps, and then you don't need to do the calculation by yourself. So what I mean is, doing a short selling is actually have a higher winning rate comparing to your betting on the price to break on certain level. So this is all that we are going to cover. First of all, we already covered that short selling actually to allow you to generate a passive income by collecting a premium, whether or not the option is exercised. And at the beginning, we say that we can actually use a short selling options to act like a buy limit order and a take profit order. When you want to buy a stock, you just make a short put. And when you make the short put, you get a premium. After you get a premium, if the order didn't get exercised, you can just make another short put after the expirations. So until one of the day, your short put get exercised and you buy in 100 shares. At that time, you already collect a lot of passive income, which is the premium, and you bought in 100 shares of your desired stock. Now you want to exit at a higher price, buy low and sell high. You already bought the low. You want to make a profit from selling the stock. So instead of placing a take profit order that will just wait until forever, you can actually make a short put. A short put is actually the take profit order that will make you a premium. When you put on the short put, you make a premium. And if the order option didn't get exercised, it doesn't reach the level, you keep the premium while the option will expire. And you can just keep on shorting a call option to collect the passive income, which is the premium, until one day it get exercised, the level get exceeded, and then the 100 share on your hand will just sell out at the desired price. In this case, you are doing a buy low and sell high, but comparing to the normal tradition buy low, sell high, which is a simple buy and sell buttons, and without doing anything, you actually can make a lot of passive income by collecting the premium. You can just keep on practice this until the option get exercised and you get into the positions. So this is a very good alternative way to replace a traditional buy and sell by using short selling input to get in to buy low, and a short selling in call options to sell out, to sell higher. And then second, we will learn on what will be the factor that affecting the premium that you collect. This can actually, you can check this before you want to get into any positions. And then what is the factor that will affecting your decisions? The first one is the volatility. And we cover 3 volatility index today. The first one is VIX, which is the market volatility. And the VIX usually stay in between 10 to 20. Anything above 20, which means that the market is actually very volatile. Now you know that the market is volatile. Which stock are you going to choose to just exercise your action of buy low, sell high? You can just check on the IV and the ATR. When the IV is greatly above the 50, which means that the company now is actually paying a very high premium instead. So with the VIX above 20 and the IV, the implied volatility exceed 50%, now you only check on the ATR. When the ATR itself is having an increasing momentum and in the blue area, so that it means that all 3 are lying together and have the same bias. The market itself and the stock itself and the option itself are having a very great volatility, so that this is actually a triple confirmation for you to get into the positions to exercise your short selling order. Please remember this, we are only doing the short selling as a replacement of the traditional buy and sell. So make sure that you choose the company you want to buy in, so that even though the option get exercised, you won't regret from doing so. The short selling is actually a method for you to generate a passive income by collecting the premium, but you only do it on your desired stock to bought in, okay? And we also, besides from the volatility, we also cover the time value. The time value, the longer the expiration date, the higher the time value, which means the premium is more expensive. So if you want to make a bigger return, you aim for the higher expiration dates. But if you want to lower your risk, you can just aim for the closer expiration dates. This depends on your preference, on your risk tolerance, okay? So last, we cover that why short selling is actually better than doing a normal long positions. Because according to the normal distribution, a theory line behind the price stock, we know that actually the stock price doesn't move significantly. It just move around the price closer to the current price. So instead of betting the price to break certain level, either is above or below, it's better to just bet on the price to stay between certain level. And you can check on the app itself. Most of them are showing the winning rate. And then you can just check on the winning rate of short selling is actually greater than the winning rate of long positions. Now we already covered that how are we going to use the short selling options to replace the traditional buy low, sell high while collecting a premium, and then what will be the factors that are affecting it, and you can use it as a filter to get a higher premium, and also the theory stay behind that support you to do a short selling instead of a normal long position. I believe that you guys will be more willing to do a short selling position instead of betting to the price to break certain level, instead of you betting on a breakout strategy. For the more details, like which stock are you going to choose, that would be depending on your style of investing. Either you want to do a fundamental analysis on the stock to decide which stock to buy, or you can do a technical analysis on the stock to decide what level I'm going to buy. and what is the direction of the stock are heading to. Remember this, short selling options is just a replacement to your normal buy low sell high. So the main focus is still on what stock are you going to buy low and sell high. Please remember that most of the time, short selling options is just a supporting item for you to get more income while you are doing an investment or trading. Do not mistaken it by replacing the options as the main focus while choosing the stock as a supplement. You need to focus on how to analyze the stock itself, then you use the short selling as a support. If you are no clue on how to choose a stock, you can just follow on our upcoming lessons. We will talk about fundamental analysis, technical analysis, or maybe some of you might like to have a news trading to bet on the news and then make a huge return on certain minutes. Okay, so before the end of our sessions, I will just introduce you one of the apps for you to get a short selling positions to just start your adventures on how to get started on the options. Usmart is actually a very good app, and then once you register, you're able to get some Tesla share voucher. You can just own some Tesla share, and then if you get to deposit more, you will get even more benefit from it. And this is the QR code that you can register the Usmart account immediately. So whoever that want to get started on their adventure on options trading can register an account in Usmart. While we will be more discussing on the future classes on how do we pick up a stock and how do we analyze a stock, and then maybe we will have a live trading session together afterwards. But it depends. The regulations and compliance might get involved in between. So that will be the end of our sessions. If there's any questions, you may start raising so I can answer you immediately. Meanwhile, we will just giving some head up on what are we going to discuss later on. In the next classes, we are going to cover what are the mainstream methods to analyze a stock. I will say that the mainstream now is actually the fundamental analysis, which is the Warren Buffett style. They will just read on the financial report or financial paper to know that how much the company is worth. And then afterwards, they will make evaluations on it and then decided what exactly the current company worth and then what is the price that it should be on. Aside from the fundamental analysis, technical analysis might also be one of the mainstream method for the people to make some trading decisions. And then maybe we will cover some technical indicators or a combination of a trending indicators or momentum indicators and maybe some theory like ICT and SMC, smart money concept. Besides that, we also have the gamble style of trading. Like we can bet on the news and then we make a trade just right before the news to bet on the direction. If you get success, the income might be very delicious compared to the others because you make the income just right after the news. just in a few seconds or a few minutes, you're able to make the returns that are greater than you're doing the other analysis. Like if you are doing a fundamental analysis, you might actually want to hold the stock for some time, even though some years. But for technical analysis, maybe the duration of you to hold the stock will be lower, maybe few months to few weeks. But for news trading, it's definitely the high risk, high return style, which is you get to know your result right after the news in a few minutes. After that, we also have some style, like I'm the one, the lucky bet style, the casino style, but I'm not very familiar with that because I'm not the one who in control of luck. So that might be a very difficult topic to discuss. If there's no more questions further on, then we will just end this section right away, and then hope to see you guys on another sessions on next week. Okay, then happy weekend. Enjoy your holiday and enjoy your weekends and also your Friday nights.